Hello, everyone, and welcome back to another round of our Stonewood study group. And if you don't know me, my name is Neil Wilding. I'm one of the partners here at Stonewood, and we host these study group sessions. Usually it's me, um, and I host them like once a month or so, just as a way to kind of keep our hands on the pulse of what's going on in our industry. And last month, we spent a lot of time talking about conversions and conversion pattern. And today's topic is really going to kind of turn into a part two to last month's discussion. So if you remember last month, we talked about the conversion pattern, and if I once I've determined that yes, I do need to convert this tax deferred money over to tax free, what should the conversion pattern be? Should I do it over 10 years, over 5 years, as soon as possible? Should I just take up until the next tax bracket, right? We talked about all of the variables that come into play. We talked about tax drift. We talked about the potential of taxes changing during the conversion. And then we also spent a lot of time talking about IRMAA. And really, that discussion around IRMAA was more of around like the objection that people may raise of to doing a Roth conversion because they're generating too much IRMAA during the conversion. And so we helped overcome that and show that it really does still make sense to convert and convert really more quickly um, with IRMAA as one of the variables in the discussion. And so if you're interested in seeing that play out, that was last month's. We always keep an archive of these recordings in your Stonewood account, so you can go and check that out if you missed it. But what it did is it sparked a tremendous amount of discussion amongst members. Um, and specifically around IRMAA. It is quite the hot topic. I know there's some marketing companies out there that are offering webinars. There's some software out there. There's lots of things out there centered around IRMAA. And so it inspired me to really take a deeper dive into IRMAA. And so some of the questions were at a high level, right? Some of our members haven't really talked much about IRMAA. So what is IRMAA? Where what's going on with it. And then others were very specific around could we use this concept of IRMAA and the potential for IRMAA to rise over time as a reason, as a driver of the Roth conversion discussion, whether you're using FIAs with income riders or FIAs as accumulation vehicle as the destination asset for a Roth conversion, or if you're using index universal life. So many people were saying is, do I need to know more about IRMAA, not just to make sure I'm doing what's right for my clients, but also to understand that this can be a real driver in the reason to convert money, much along the lines of if taxes are going up, we need to convert to tax free. Well, IRMAA is going up too. Is that just another reason? Are we piling on reasons to convert? And so that led me really down this kind of line of thinking like, well, yeah, it makes perfect sense. So what I'm going to do first is kind of go high level, just kind of talk through what IRMAA is. Again, for those of you that understand IRMAA, that might be a bit of a little too high level for you, but we are going to dive deeper, and I want to introduce a few concepts, at least the way that I'm thinking of things around IRMAA. So, just some of the basics on IRMAA. Your clients start paying that at age 65. Now, it does impact them at age 63, as we talked about last week. There's a 2-year look back. So when they go to calculate your IRMAA, um, it is basically it's based on income from 2 years ago. And so even though you don't start paying it till 65, if you're doing a Roth conversion for a 63-year-old, certainly could impact what they have to pay in IRMAA when they turn 65. So it's important to understand that distinction. Now, IRMAA, for me, I kind of think of it as like a tiered cost, much like the way our tax brackets work, based on income, and the higher your income, the more IRMAA you're going to have to pay. And to me, the most alarming part of understanding what IRMAA is the fact that it's already baked into law that increases can occur. which varies a little bit from taxes, right? So if taxes change, they have to meet and they have to discuss what those and get those passed into law, right? Those tax changes. And that's why we talk about the current tax policy, the Trump taxes, and how they can sunset, or they're going to, sunset, because those are more tied to time. With these, IRMAA, the law is already there, and they do, the IRMAA that you pay or your clients pay increases every year. Um, and so it's important to understand that, look at history. We're going to do some of that. But to me, what that tells me, real at a highest of high levels, is that okay, so if they're using IRMAA or if they're using income to calculate your IRMAA, then obviously the more tax-free income you have in retirement, the less that IRA income, or the less IRMAA is going to come into play for you, right? So obviously, not only for tax purposes, but also for IRMAA purposes, we want as much money as possible on the tax-free side of things. So again, that's pretty obvious. But what that leads you immediately to the discussion is like, well, what about all these IRAs, right? The majority of retirement assets, or majority of just assets in motion in general, are in these tax deferred plans, IRAs. And as a Stonewood member, you're talking to us all the time about converting money from tax deferred to tax free because taxes are going up. But now with IRMAA, does it bring in this discussion about, okay, so how does IRMAA come into play with my IRA money? And so that led me down this thought of this concept of units of IRMAA. Because the IRMAA calculations are tiered, right? So once you cross into a new tier, you have to pay a higher premium. And you cross into another tier, you have to pay an even higher premium. And each one of those tiers is basically the same level of increase. So that led me down the path of thinking of this really in terms of units. It brought me back to, high school math classes, statistics and geometry, chemistry even. It's like we were always thinking about units of measure. And so I started thinking about IRMAA in this concept. And so work with me here. The first thing I need to do is, okay, so if my IRMAA calculation really just determined, like, how many units of IRMAA am I adding into the equation, which tells me how much higher I'm going to have to pay on IRMAA. Well, what's the value of that unit? And so let me kind of do the quick math on that one for you. Really what I did is you just kind of take a look at, this is just showing on the screen now just one tier. And it's for a couple. And it's like if you jump from 322 up to 322,001, suddenly you're paying more IRMAA. And remember, IRMAA applies, you have Part B premiums and Part D, right? So for me to calculate the IRMAA unit value, I just need to look at, okay, how much more do you pay when you cross over a tier, really? And that's all I did here. And so in calculating the difference in the tiers, you just subtract one from the other. This is not high level math here yet. And so you look at on the Part B side, when you jump up to another tier, you're paying an extra $104.80. When you jump up on the Part D side, you're paying an additional $20.50, right? So getting out my simple, little calculator here, the 104.80 plus the 20.50, what that tells me is that $125.30 is my unit of measure, right? Like, so every time I jump to another tier, I'm paying an extra 125.30. That's just per month, right? So at 12 months, if we're looking at this from an annual perspective, the number there to consider is $1,503.60. That is your unit value for IRMAA. But that's per tier, right? So every time you jump a tier. So if you jump 2 tiers, that's not just 1503, it's more, 1503 times 2. If you're jumping 3 tiers, that's times 3. So, and that's an annual number per tier, but not just per tier, it's also per year, right? You got to pay those premiums technically monthly, but it's that's not a one-time thing. You're paying that 125 extra a month, 12 months. It's so for every year that you're paying IRMAA, is basically a unit of measure. And by IRMAA, I'm talking about extra IRMAA, right? Because what I'm looking at here is the impact of an IRA or an IRA distribution on what you were already going to pay, right? So if I'm going to, if I've got a base income and now I've got more money coming in because of my IRA, it's going to jump me up either one tier or multiple tiers. And that's going to be every time I take a distribution. So you can kind of see the math at play here. But I'm not done. It's also per person. So if you've got a married couple, there's another multiplier there. So hopefully you can start to see why I'm trying to think of this really in terms of units and units of IRMAA, because every time you add in a multiplier, it's that 1503 times that multiplier. And so the higher those numbers get can really drive you into seeing that IRMAA and the potential changes in IRMAA can have a dramatic impact on your client's after-tax income. So, by the way, just one last piece there, and it already flew up on the screen. That 1503.60, that's the price today. But remember that fourth bullet point on my initial slides there, set of slides? It's baked into law that those are going up. And every year they have a calculation that tells you what that's going to be. So there are annual increases to that 1503. But for our consideration here, if we're going to calculate the unit value of an IRA's impact to your IRMAA calculation, you basically, the more units of IRMAA that you're forced to consume, you're going to pay 1503.60, right? So that's the key number. And we actually used that number. I think we used a rounded version of that number in last month's study group. But there's your number. So now the question becomes, all right, so if I'm thinking of this in terms of IRMAA and units of IRMAA, and I've got my unit value of IRMAA is just over $1,500, now the big question becomes, okay, how many additional units of IRMAA is my IRA distribution going to force me to pay? And so in order to do that, we're going to kind of do this one in Stonewood fashion, where I'm going to look at that really through two lenses. The first lens would be if I just keep this money tax deferred. How many additional units of IRMAA will you have to pay from an IRA distribution? So if you're going to keep that IRA, IRMAA doesn't come into play until you take money out. But remember, there are rules in place where you have to take that money out. So there is going to be impact. But we're going to look at each one of these. We're going to calculate each one of the variables in play here. So the first is how many years will you have to pay additional IRMAA if you just keep that money in an IRA, and how many years will you have to pay an additional IRMAA if we convert that money now? The second one is those tiers, right? Okay, so if we know how many years we're going to have to pay it, how many tiers will the IRA distribution impact, right? So is it just going to jump me one tier? Will it be multiple tiers? We're going to look at that obviously through the lens of keeping the IRA, and then through the lens of converting that money. And then the third one is people, right? Are we married or are we single? And those really are the variables that we're going to use to calculate the total units of IRMAA that you would have to pay over your lifetime. So from the IRA side, right, that's going to be all based on longevity, right? How long are you going to live, right? Because every distribution that you take out, whether it's through a required minimum distribution or through just like a set distribution over time, that's going to tell us, like we need to know that, or at least make that assumption if we're trying to calculate these units of IRMAA. And then we have to look at what tier we're in, and that is going to be dependent on where our base income is starting. So when you think about it, you really have, if we're looking at, okay, what is the impact of an IRA on my IRMAA calculation? Well, you have to know what kind of other income is out there. So do we have a non-IRA income? Is the client still working? Is there some sort of income that establishes the base, to whereas then the additional IRA money then becomes an additive? to it, right? And that's what we're trying to calculate is the IRA's impact. So we need to look at the difference there. And then, of course, we need to know, are they married or single? And so if you know those three things, you can really calculate how many units of IRMAA you'd have to pay. And then now if we convert that money, the variables are the same, but what we need to assume within those variables can be very different, right? So if we're going to keep the IRA, that money is lasting over a lifetime. But if we're going to convert that money, well, then it's only impacted during the conversion years, right? So so that could be 1 year, it could be 10 years, it could be, however many. Even in general, if we're converting money, that means we're trying to get, build an exit plan to that IRA. So it's going to be traditionally shorter on this one for like a conversion as opposed to keeping the IRA. This is the big one though, the potential for multiple, like a large multiple during the conversion. So if we are converting money and we're doing so in a short pattern, 1, 2, 3, 4, 5 years or so, that means that we're probably going to jump multiple tiers in terms of our units of IRMAA during the conversion. And so then the question then becomes, is it worth it, right? Is there some sort of break-even analysis? And that's why I'm kind of going through this exercise with us. It's going to kind of tell us. And then, we still have to know, are we married or single? But if we know that if we're just keeping the IRA, we just say, okay, how long are we going to be alive and taking money from our IRA? What is the impact of that IRA on your tier? Where do you fall? And then you married or single? That'll tell us a total unit of measure for an IRA. And then if we're just going to keep that or convert that money, what's your conversion pattern? And then what type of multiple are we looking at? Are we jumping 1, 2, 3, 4, 5 tiers of IRMAA during the conversion? And then are we married or single? All right, so I'm kind of setting the stage here. Hopefully you're following me, and because I know I'm kind of introducing this new concept of this units of IRMAA. But even though this might be kind of a complex walkthrough here, the point is to really think of this in simplistic terms. So when we look at an example here, we have a couple age 65. So they're already living in IRMAA. They're already having to pay their IRMAA. And they have $1 million and they have $57,000 of income to their life expectancy. So the way that I calculated that number is I just actually used our Stonewood software. And I just ran an income report and I said, okay, if I've got $1 million based on realistic, reasonable growth assumptions, 65-year-old couple, how much income could you take and make a last age, in this case, 65? And that answer was after taxes, $57,000 of income to life expectancy. So I got a $150,000 income base. Now, here's the question. So I'm starting with $150,000 and I added actually it's like 80,000, right? After tax, it'd be 57. So that's the world I'm living in here. And now I'm going to say, okay, what kind of units of measure would we be talking about here in order to take and add in that IRA to the mix? And I'm going to look at it and say, okay, if I'm just keeping the IRA, what type of, how much IRMAA impact am I going to have just in terms of units? And then what if we just went really fast and we converted this money in 2 years? What would the impact of the IRMAA or the impact of that IRA Roth conversion in a 2-year pattern? What would that look like? So if I just keep the IRA, if I'm a couple age 65 and we're going to life expectancy, it's about 20 years. And so you're looking at 20 years worth of paying IRMAA. And that would be if you had a $150,000 income and you had 57,000 of after-tax income added to that, then that's only jumping you one tier. It's basically just jumping into the next tier, one tier for 20 years. Couple, right? By definition, that means it's two people. So really what you're looking at here is 20 years worth of paying IRMAA for two people, and we're just paying one extra tier because of that IRA distribution. So my total unit of measure there is 40. Now, what would my units of measure be if we converted this, right? So if it's a 2-year conversion, that means you're only paying IRMAA now for 2 years on this money. Now, again, I'm not talking about total IRMAA payment. I'm talking about the IRA's impact on IRMAA, right? And so if we convert this money in 2 years, that means we're really only taking taxable income out of the IRA for 2 years. Now we're doing it all at once. So those are two really large distributions to conversion, right? So that means we're going to jump a bunch of tiers. And that's right. We're actually looking at 4 tiers there. And that's really where most people think, oh man, Roth conversions have this tremendous impact on IRMAA. And like if we're going to convert this money and we're going to do it in 2 years, man, we're jumping 4 tiers. That's 4 units of measure, but only for those 2 years. And for two people, really, you're only looking at like 16 units of measure. So my simpleton mind says, okay, if I keep the IRA, I'm going to have to pay IRMAA, all right, an extra 40 additional units times the $1,500. That's a pretty good difference between only 16 units of IRMAA. You follow my logic there? All right. And so to me, I went through this exercise really just to tell a simple story to say, you know what? It is okay, even during a conversion. And if we're jumping 4 tiers, you're still only doing it for a short time frame. And the payoff is in spades on the back end. All right. So now, and that's, by the way, only living to 85. So now if we live to age 95, suddenly that's 30 years if you keep the IRA. You're talking about 60 units of measure as opposed to still the 16 if we go through the conversion. So what that's telling you here, obviously, is like longevity comes into play. And so the longer the life expectancy for your client, the more urgent it would be for them to convert and pay that money now. Because the more that we convert, the longer that we live, if we go through the conversion, that means you're not paying IRMAA on that money for that long, healthy life. But if we keep that IRA, you got to keep paying that IRMAA as long as that income is there. So anyway, that's kind of and by the way, I'm sure many of you are already used to talking about longevity and using annuities to protect against longevity. Well, actually, a Roth conversion with those assets either landing in an annuity or using IUL, life insurance chassis, whatever it may be, it actually has some longevity protection into it based on this concept of units of IRMAA. Okay, so that kind of tells me, all right, at current cost per unit, makes total sense. We need to convert this stuff as fast as possible. And that's before you even take into the fact that the price of IRMAA, the unit price of whatever we want to call that widget, is going up. And it is baked into law that it is going up. And so when you look at history from 2007 to 2024, IRMAA has been increased. The lowest increase that we've seen is 4.73%. The highest increase we've seen is 8.02%. So that tells me if history is our guide, those increases are going to fall within those ranges. So if we're starting at 1503 and we're looking at that higher, percentage, that's every year. So that becomes its own multiplier in a sense. So not only do our units go up, but the cost per unit is also going up on it. So I just ran some quick numbers. Again, forgive the simpleton math here, but if you're starting at 1503 and you're looking at a 4.73% increase, your cost per unit in 10 years goes from 1503 to 2386. And remember, per tier, per year, per person, right? So that number really starts to multiply. And that's just 10 years. By the time we get to 20, right, we're talking, if we're 65 and clients are living to longevity, you're looking at least 20 years of increases. Now you're talking about more than doubling the cost of what you're paying here per unit. And that, by the way, is at 473. That was the lowest increase we've seen since we've had IRMAA. Now, if we were to apply the highest one, now I know this is meant to just set the high end of it, right? I'm not saying it's happening at 802 every year, but if we did experience, if the highest in the past became the new norm and we saw an 8.02% increase, Like, to me, this is where the risk really starts to come into play. Like, as advisors, what are we doing here, right? We're trying to mitigate risk, and take unknowns out of it. This is one of the unknowns. Let's get these assets out of the line of fire, because if it's 8.02% increase, my cost per unit in 20 years goes from 1503 all the way up to over $7,000. And that's just per unit, per tier, per year, per person. So finally, the big takeaway here, right? What are we doing? So we looked at this first through like total units. And we have a situation where clients can keep their IRA. And if they just stay in the IRA, and we're looking at IRA assets, the total units of IRMAA that they're going to be looking at are, it's all based on longevity. So the examples that I had, between 40 and 60 units of IRMAA that they were going to have to be paying over their lifetime. But if we convert that money, you can see how low the total units are. Now, are they paying more units up front? Yes. But see, that's the point, because what else is going on here? The cost per unit's going up. And so what used to be, or what is currently 1503, very shortly is going to be 2386 or 3789, or could be up to north of $7,000. And that's the risk, is that we have like the kind of double the impact, right? So by converting these money, by converting IRA dollars into tax-free dollars, do you have to pay more money up front? Yes, but that is the point, because we want to buy them now. Just the exact same conversation we're having with taxes, right? How many times have you said taxes are on sale, right? Taxes are artificially low, and we know they're going up, right? So that's a reason to convert. Well, IRMAA and this whole conversation is just a continuation of that same tax conversation, because you know what's also on sale? Units of IRMAA. And so let's go ahead and assume more of that now through the process of a conversion. Now, I'm not saying you got to go in and convert all your IRA assets into 1 or 2 year conversions. Maybe it makes sense to spread it out a little bit more, so year 3 to 5 years. But just know that the more that you spread it out, the more you're adding to those total units. And then also, the further we go out on the calendar, the more we're going to be subject to these annual increases on the cost per unit of IRMAA. So I know I kind of took this conversation and I tried to simplify it really down to just a unit. I know there is some complexity that came with that, but hopefully you kind of see what I'm trying to say here. At the end of the day, right, the big takeaway, shocking here, I know, coming from me and someone that has lived in the Roth conversion, is a good idea for your client's world for years and years and years. Guess what we're saying? Keep it up, right? Continue to be the advisor in your market that can articulate not only tax risk, but IRMAA is another tax, and understand that we need to convert that money. In all of that tax deferred money, let's convert it. And you know what? Let's not be afraid to assume some of that money early, right? Let's go ahead and buy out those units early. Let's convert that money quickly. And whether that's we're doing Roth conversions with money landing into FIAs, either with income rider or just as accumulation based, that is, it just makes so much financial sense to go that way. Or if we're going to use a life insurance chassis, and we're going to go ahead and take that money and take it out of the IRA and use that money to buy life insurance, it's off the books as it pertains to IRMAA for that as well. So happy converting, everyone. Hopefully this was helpful. I'd like to just try and put a different spin on things. And so hopefully this has helped. By the way, if you've seen the last 2 study groups that we've done, has mentioned IRMAA. It should serve as a little bit of a spoiler to know that when we go into the product development factory, we're looking for simple ways to enhance our tools, whether it be our webinars or our marketing content, seminar content, white papers. You're going to see a lot of IRMAA coming out of the Stonewood factory here in short order. And we're also looking into, how can we start making some of these calculations for you in the form of a high-level, simple software report in the same vein as our total tax burden analysis. So hopefully this is very helpful for you all. If you want to schedule some coaching, as always, grab some time on Alec or anyone on the member success team. If you're looking to kind of learn more about what's out there for Stonewood, you can put some time on Tyler's calendar. And I'm going to call to attention one more thing. I know it's coming close. Here in a couple of weeks, we are hosting Innovate. We have, I think we just hit 100 on the registration list today. So it's probably getting close to selling out. It's one of the best things that we do. I'm super proud of the event that we host. It is basically our 2 days of training from all of the best of us here at Stonewood. And it's not like, how do I structure my contracts? No, this is marketing. This is practice management. This is how can we change your language so that you can position yourself as the expert in your area that can articulate this new and emerging risk that your clients face, and then how to build plans to help mitigate that risk. So as always, thank you all so much for being loyal Stonewood members, whether you just came on this month or you've been with us for 7 or 8 years. I thank all of you equally for being loyal Stonewood members, and hope to see a bunch of you in Louisville here on September 15th, 16th and 17th, I think, is when that event, where we're hosting that next training event. So thanks again. And as always, keep the conversation coming. Shoot me notes, shoot me emails. Love to continue to talk more about how you're incorporating not just IRMAA or the Stonewood tools or everything that we offer here into your practice every day. Thanks. Have a great one. Bye-bye.